Welcome back to Money, Money, Money. So we've gotten the lowdown on equity mutual funds, but what about the debt variety? What's the scope there? Firoz Aziz of Anand Rathi Private Wealth Management is our guide this week, and he's been answering all of these questions and a lot more. So Firoz, finally on to debt then. You've already raised quite a few valid points about the fund management charges, etc. But within debt, should one actually look at now the balanced fund? I know that it has the tax treatment of an equity fund, but a lot of people look at it to satisfy their debt criteria. Is that okay? I mean, should it be a part of your debt portfolio?
It can't be a part of your debt portfolio. See, but it's very good for somebody who's doing a systematic investment plan. If he doesn't have large lump sum investments, if he's doing systematic investment plan, a balanced fund is a very, very good method because he's recurringly investing. If he did the same thing with a debt fund, because there is 3 years for it to become long term as against 1 year, then every installment needs to finish 3 years, which is very difficult, right? So you use a balanced fund. Now here, every installment needs to finish 1 year, which is a relaxed knob. But if you're doing a lump sum investment, you can definitely envisage that you will stay invested for 3 years. But if you're doing a systematic investment plan, and then you have a fewer of your installments which are finished long term, and fewer of them which went 6 months back, and you can't touch the folio at all. You can't redeem the money. So if you're doing SIPs, a balanced fund is a very, very good option. But if you're doing lump sum, you're better off splitting the money in the best large cap and the best debt fund and stay invested for 3 years. That's right.
And has the time also now come to choose between duration funds and accrual funds? I mean, should one now forget about capital appreciation and just start looking at the interest income?
See, I personally think that people generally have a tendency to move from one end of the spectrum to the other. So this spectrum actually has some funds called the short-term funds and funds which don't aspire to have capital gain. They only try and get interest income. The other end is a gilt fund, whose large portion of the return is going to be capital appreciation. Don't move from this spectrum to this. So there are two other steps in the middle. Just go from this step to this. And the second step is a dynamic bond fund, which says that in 3 years, which is going to be my investment time frame, there will be periods where taking interest rate risk or taking duration might not make sense. Let me delegate that decision to the fund manager so that in 3 years he might change the opinion 2-3 times and I don't have to do that. So move from accrual funds, which generally focus on only the interest income, not the interest risk. A dynamic bond fund delegates the interest risk management to the fund manager, and then moving to income funds and gilt funds. So no to these income funds and gilt funds. Dynamic bond funds definitely could form a part of the portfolio today.
Okay, then let me give you another set of choices, which is between a taxable bond fund and a tax-free bond, right? Because the return, the difference in the return would be about 100 basis points higher for a taxable fund. So even if I stay invested for 3 years, would it not make sense? Because even in a tax-free bond, I would stay invested for 3 years or more. So wouldn't a taxable bond fund then make sense for me?
Taxable bond fund would make sense. See, actually, this quarter, you've reminded me of one very, very important point. Trying to build your portfolio in the first quarter of the calendar year, which is Jan to March category, you will be able to get 4 indexations if you actually invested today and exited in April 2019. So a debt fund becomes zero tax if you actually got 4 indexations for 3-quarter years. So in this quarter, this question is so valid that you should take up a taxable debt fund, because by the virtue of having indexation, it will become tax-free anyway. So you're better off getting that 1.25% more than a tax-free bond and not losing out on the 1.25%, which is a large component in a debt category. Because so I would say you should use a taxable debt fund rather than a tax-free bond, if not anything, at least in this quarter, and exit in April 19, which will give you 4 indexations and you will be on a tax-free tangent.
What about the rest of the year?
Rest of the year, you need to again introspect on the differential return between the tax-free's availability and the debt fund. Right? Now the differential is large enough, 1.25%, I would not let go of on the debt category because it's a very large jump. I would rather take a taxable debt fund. Then if the differential is narrow, then you're better off in a tax tax-free bond, but if the difference remains as 1/4, you should certainly go with the tax-free bond. The taxable mutual
bond. All right, Firoz, on that note, thanks very much for joining in. I hope you have a fantastic year.
You do
and
too.
Thanks very much once
Thank
again.
you, Sumera.
All right, on that note, it's time for us to wrap up. It's about all we have this week. Viewers, remember, keep writing to us at moneymoneymoney@network18online.com. You can also find us on Twitter. Write to CNBC TV 18 News. Use the hashtag money. And remember that you can also log on to YouTube to catch this as well as all our previous episodes. Thanks for watching. We'll see you again next week.